a $10,000 cash down payment, leaving his
Stan decides to buy a used truck with a satellite dish, which he can use as an office as well as a broadcast center. They cost $100,000. That's right, $100,000. Stan's a little new at this. For the sake of clarity, the truck and the satellite dish are represented by the building account.
The truck and satellite dish cost $100,000 with a $10,000 cash down payment, leaving his long-term mortgage at $90,000. So on our books, Stan's cash decreases by $10,000. His building account, an asset, increases by $100,000, and his mortgage payable account, a liability, increases by $90,000. So you add up all the asset account balances, then you add up all the liability and owner's equity account balances. You can see that assets equal liabilities plus owner's equity.
Stan then buys $5,000 in office equipment, such as cameras, wires, and satellite equipment to install his network. To do this, he pays $2,000 in cash, with the rest due by the end of the year.
Therefore, on our books, Stan's cash account decreases by another $2,000. His office equipment account, an asset, is increased by $5,000 because he has $5,000 in office equipment, and his accounts payable account, a liability, is increased by $3,000.
As you'll see, the accounting process begins with the general journal entries and then moves to the ledger.
With a manual accounting system like we're using, general journal entries are made daily, while posting to the ledger is done on a slightly less frequent basis. With a computerized accounting system, the process of posting to the ledger is either automatic or entered with a few keystrokes.
We divide the life of a business into accounting periods. It may be by a month, a quarter, or a year. At the end of each accounting period, we'll prepare financial statements that report on the health of the business.
In order to follow the realization and matching principles of GAAP, revenues and expenses must be recognized in the accounting period in which they are earned or incurred, and not necessarily when cash changes hands. This system is known as the accrual basis of accounting. This method is opposed to the cash basis of accounting, which records revenues and expenses only when cash is received or paid.
The accrual basis revolves around the fact that businesses must account for expenses that have been incurred, even though the cash has not gone out for them yet. The cash basis of accounting can be used by simpler businesses and individuals like a child, or my brother Fred.
Peanut butter!
The accrual basis of accounting is more accurate and is a vital system for an accountant to learn. We'll go through an example of the accrual method to show you why it's more accurate than the cash method.
Stan performs services on credit for $500. In other words, his first group of subscribers charge their subscription on the credit account they have with Stan.
So on our books, because he has not yet received payment, accounts receivables, or money customers owe to Stan, is increased by $500. Also, Stan has earned $500 in revenue from the subscribers to his network. This revenue increases owner's equity, so the two sides still balance.
If the accountant had used the cash basis of accounting, he or she would have not recognized the revenue until the cash is received. Therefore, under the cash basis of accounting, revenue could have been understated. The reports generated after the first week would have been inaccurate, and you can't have inaccurate accounts or reports. That's why the accrual basis of accounting is so important.
Stan then decides to purchase another $500 in camera supplies on credit. He has a credit line with his supplier, so he puts the purchase on his account.
On our books, his supplies account, which you recall is an asset, increases by $500, and his accounts payable, a liability, also increases by $500 since he still owes the money. You can still see the double entry nature of accounting and how the sides balance out.
Being an honest and upstanding citizen, Stan prepays his utility expenses for the next 2 months, costing him $200.
So, on the books, his cash account, an asset, decreases by another $200, and his prepaid expenses account, another asset, increases by $200.
You can find this worksheet on your standard Deviants insert card.
Now, If you add all of the balances from the asset side, and you add all of the balances from the liability and equity side, you will see that assets equal liabilities plus equity. So, the accounting equation stands true. Assets must always equal liabilities plus owner's equity.
As you can see, it is very important that the accounting equation always remains in balance. If you're recording transactions and the equation does not balance, you know that you made a mistake.
Can't you see? Balanced accounting equations are good. Unbalanced ones are bad. Very, very bad. Sheesh!
Editor's note. The proprietor of the Bathroom Network, Stan, is a fictional character. Stan was created by this man, Alan Canant. Alan is a Capricorn who enjoys various activities like hiking and racquetball. For more information about Alan Canant, look somewhere else.
Part 2. Double Entry Accounting. Yeah.
You've been doing double entry accounting for this video already. As we said, every time a transaction occurs, it's double the trouble for accountants. Whenever we record a transaction, at least 2 accounts are affected.
Section A. Accounts and the ledger.
People keep accounts in many different forms, both in computers and on paper. Next, we'll talk about the way the information gets into the accounting system. All the accounts are entered and organized in what's called a ledger.
The ledger is the formal name for the books, or book of accounts.
Now let's talk about the way information gets into the accounting system, okay? You start. No. Okay, I'll start. Earlier we introduced the 5 major account types. Now let's talk about how they're used in the ledger. You guys are a real bright bunch, aren't you?
As we discussed earlier, most accounts may be classified into one of these 5 major account types. These account types are shown as T accounts because they look like capital T's. These are the super accounts we discussed earlier.
The T account is shaped like a T. It is used to determine a balance of a particular account. The T account has 2 sides. The left side of the T account is called the debit side, abbreviated DR, and the right side is called the credit side, abbreviated CR.
The account balance is the difference between total debits and total credits.
If the total of debits is larger than the total of credits, then the account is said to have a debit balance. If the total of credits exceeds the total of debits, then the account is said to have a credit balance.
People studying accounting often confuse the meaning of the words debit and credit. In accounting, debit means left and credit means right.
Debits and credits are simply accounting tools that are used to increase and decrease balances in accounts. The effect a debit or credit has on a particular account depends upon the type of account you are talking about. In other words, the effect a debit or credit has depends on which of the 5 account types you are dealing with.
I'm super accountant, and I will help you with your super accounts. I will go through each of the super accounts and tell you whether a debit is an increase or a decrease, and whether a credit is an increase or a decrease. The reasons for this will make more sense as we work through examples. Just remember, left means debit, right means credit.
Thank you, accounting man.
That's super accountant.
Super accountant.
It's okay, I'm not offended. I will use T accounts to illustrate how debits and credits work in accounting. It is vital to your safety as an accounting student to understand the following about how debits and credits work.
When you want to increase an asset account, debit it. If you want to decrease an asset account, credit it. This is shown on the screen as a plus or a minus.
It's exactly the opposite for liability and owner's equity T accounts. To increase a liability account or an owner's equity account, credit it. To decrease a liability or owner's equity account, debit it. This can again be seen with a plus and the minus on the screen representing an increase and decrease. Now I want to discuss the 2 remaining account types, revenues and expenses.
I think I can take it from here.
Then carry on, my little accounting buddy.
We said earlier that revenues increase owner's equity and expenses decrease owner's equity. This is true, but it is also important to understand how revenues and expenses themselves are affected by debits and credits.
Wait, somebody's in trouble. They're adding wrong.
Revenue accounts are increased by crediting them and decreased by debiting them because an increase in business revenue increases owner's equity.
Expense accounts are increased by debiting them and are decreased by crediting them because an increase in business expenses decreases owner's equity.
Now let's talk about how debits and credits are used to record transactions in the accounting system. Transactions are first recorded in the accounting system in what is called a general journal.
Section B, the General Journal.
As the day comes to a close and another gruesome battle has ended, I must tabulate the day's losses. 10,000 shells fired, 3,000 limbs severed, 500 desertions, and strangely, 23,000 cases of syphilis. What's even more strange is I only had 10,000 men. Maybe I should speak with my accountant.
What next, sir?
We must continue the accounting process. Give me your hand, soldier! Now get out of here!
Sir!
Dismiss!
An accountant records all transactions for the first time in one place. The reason for recording all transactions into one place first is that it offers an area to check for accuracy and reference every single transaction. Also, this is a quick and easy way to record several transactions at the same time.
These initial recordings are done in the General Journal, sometimes known as the Book of Original Entry or Book of Transactions, but never as the Book of Ultimate Evil. This is not an account, but rather the first place a transaction is recorded.
Notice for the General Journal that there is a date column, account titles, an account number column, and debit and credit columns. It's almost like your checking account register without the balance.
The posting reference or account number column holds the numeric reference assigned to an account when the transaction is posted. For basic accounting, the account number may not be very important because often the account name is sufficient for referencing. But for businesses with hundreds of accounts or those that use computers to keep their accounts, these numbers are useful. A listing of the accounts and their account numbers are illustrated in what is called a chart of accounts.
To record a transaction in the General Journal, place the date of the transaction in the first column. In the next column, the name of the account that is to be debited is written in the first line, and the account that is to be credited is placed on the second line and is indented. A brief written explanation of the transaction is shown below the listing of the accounts. The appropriate dollar amounts are entered in the debit and credit columns.
The rules for recording journal entries in accounting are very strict. Just like my father. God rest his soul. It was because I could never get his approval that I went into acting. So I could get the approval of others, of an audience. You were my love! Damn it, Dad! Where was the love?
Anyway, you always enter any accounts and dollar amounts to be debited before you enter your credits. In addition, every transaction will contain at least one debit and one credit. And one final rule: debits equal credits. This means that for any journal entry, the total dollar amount debited has to equal the total dollar amount credited.
To further explain general journal entries, we'll go back to the bathroom network.
Stan's initial investment transaction is recorded in the General Journal by first debiting cash for $13,300 because you record an increase in an asset account with a debit. Then you credit the owner's capital account for $13,300 because an increase in an equity account is recorded with a credit. Finally, a brief explanation for the transaction is recorded in the General Journal.
In the buying of the truck, the building account is debited $100,000 since an increase in an asset is recorded as a debit, and the mortgage payable and cash accounts are credited for $90,000 and $10,000 respectively. Mortgage payable is credited because an increase in the liability accounts is recorded with a credit. Cash is credited because we are decreasing an asset account.
For the office equipment transaction, the office equipment account is debited $5,000 because an increase in an asset account is recorded with a debit, and the accounts payable is credited for $3,000 because we're increasing a liability. The cash account is credited $2,000 because it's an asset that's decreasing.
Purchasing supplies with cash debits the supplies account for $100 because an increase in an asset account is recorded as a debit. It credits the cash account for $100 because a decrease in the cash asset account is a credit.
So, who have you done accounting for in the past?
Well, I used to do some work on the scrolls for the Pharaoh of Egypt, and then I did a little bit of work for Amadeus before he got the gonorrheus. And since then, I've been back here in the States, and I did a little work for Johnny Rotten. Speaking of rotten, you smell something? Oh, boy, that's a stinker!
Performing $500 of work on credit is entered as a debit to accounts receivable, an asset that is increasing, and as a credit to service revenue, a revenue account which is also increasing.
Buying $500 supplies on credit is entered as a debit to supplies and as a credit to accounts payable, a liability account.
And prepaying for expenses is entered as a debit to prepaid expenses and as a credit to cash.
Okay. Let's review what we just did.
Now the review. We recorded each of our transactions in the General Journal. The process is often called journalizing transactions. The journal is the first place transactions are entered into the accounting system, and every entry contained at least one debit and one credit. Debits were entered first, and credits followed. Our journal provides a list of every transaction the Bathroom Network conducted for a period. Whoa! Whoa!
Section C, the General Ledger. The next step in the accounting process is known as posting to the ledger. This involves taking the same information that's in the journal and transferring it to ledger accounts. Where the journal shows information by transaction in chronological order, the ledger shows the same information arranged by account type.
There are two formats for the ledger. Both formats can be used to represent the ledger. There's the T-account form used mostly in colleges, and there's the balance column format.
The balance column format is most often seen in businesses. The first column is for the date of the transaction. The second column explains the transaction. The third column records the posting reference number, and then there's a column for the debits, credits, and the balance of the account.
So the amount of the transaction, whether debit or credit, is placed in its appropriate column.
How do you know whether it's debit or credit?
Well, when we post to the ledger, we are simply transferring what was already done in the journal. If we debited an account in the journal, we will post it to the ledger as a debit. If we credited in the journal, then we credit it to the ledger.
Asset accounts are generally debit balances. Why? Because an increase in an asset account is recorded as a debit, and increases in assets are more common than decreases. If they weren't, everyone would be bankrupt. Liability accounts are usually credit balances, because increases in liabilities are credits for that account. The normal balance of an owner's equity account is a credit because an increase in an owner's equity account is a credit.
We'll use Dan's business as an example of posting to the ledger. First, transaction number 1, which is his original cash investment of $13,300. The two accounts on the ledger involved in this journal entry are cash and capital.
In the cash account in the ledger, the item in explanation is transferred from the journal. Then, the posting number, or account number, is placed in its column. The posting number for the ledger is simply the page number where the transaction appears in the general journal. This $13,300 transaction appears on page 1 of the journal. Then, the $13,300 debit is placed in the debit column, and the balance of the cash account after this transaction is a $13,300 debit balance, since it was zero before this.
The same is done for the owner's capital ledger account. The explanation is provided, then the posting reference is transferred. The $13,300 credit is placed in the credit column, and after this transaction, Stan's capital account has a credit balance of $13,300.
So that's it for posting the first transaction from the general journal to the ledger. We came, we saw, we posted. Now let's post another entry to the ledger.
Remember that Stan bought his truck at a cost of $100,000 with a down payment of $10,000 and a mortgage of $90,000.
In the building account, we debit $100,000, resulting in a debit balance. Next, we must credit the mortgage payable account and the cash accounts for $90,000 and $10,000 respectively. At the end of this transaction, the mortgage payable account has a credit balance of $90,000 because it was zero and we increased it by $90,000. The cash account now has a debit balance of $3,300. Why? Because it was $13,300 after the initial investment, and we just decreased or credited it by $10,000, leaving a $3,300 balance.
We've now posted two transactions to the ledger. You might want to rewind this and try again. The rest of the transactions we journalized would be posted to the ledger in the same way. However, to save time on the tape, we won't go through all of them.
Section D, the trial balance.
The next step in the accounting process is to prepare a trial balance. A trial balance summarizes the ledger by listing all the accounts and their balances.
Storm.
Where's my lipstick? Has anybody seen my coffee bean lipstick? It's a new color that I got from Lord. Thank you. I knew you had it.
Let's go to our reporter who's at the 16th Annual Accountant Running Trials.
Well, the rain has finally cleared, and just in time for today's Accountant Running Trials. Let's take a sneak peek at the championships as they warm up. It's interesting to watch all of the different tactics that they use, the stretching, the warming up.
A trial balance is a statement that shows the balances of all the accounts and calculates the total debits and total credits for the whole business.
Well, it looks like they're ready, so let's take a look at the action.
Gentlemen, on your mark. Sit.
The trial balance does not check the accuracy of the actual entries because an amount can be entered into a wrong account and still allow the trial balance to be equal. We're going to use the T account format to illustrate trial balance entries.
First step, balance each account by adding up the left and right sides of each T account. Second, you get the balance of the T for each account by subtracting the right side from the left side. If the left side is larger than the right side, you have a debit balance. If the right side is larger than the left side, you have a credit balance.
First, the balance of each T account must be calculated. So, add up the right and the left side of each T.
Looking again at the bathroom network, we will go through each of Stan's ledger accounts and prepare a trial balance. As you can see here, the cash balance is a $1,000 debit balance. The accounts receivable balance is a $500 debit balance. The supplies balance is a $600 debit balance. The prepaid expenses balance is a $200 debit balance. The office equipment balance is a $5,000 debit balance. And the building balance is a $100,000 debit balance.
Up to this point, all of Stan's accounts were debit balances because the debit side, or left side of the T, was larger than the right. Now let's check out some credit balances.
The accounts payable balance is a $3,500 credit balance. The mortgage payable balance is a $90,000 credit balance. The capital balance is a $13,300 credit balance. The service revenue balance is a $500 credit balance.
So you add up all of the balances to give you a trial balance for the company. For Stan, the following statement shows a total of $107,300 on each side, both debit and credit. If the total dollar amount debited doesn't equal the total dollar amount credited, we would know we messed it up.
Section E. Adjusting entries.
The accounting process does not always automatically provide us with the right balances. At the end of an accounting period, adjusting entries must be prepared before we prepare the financial statements. For example, situations arise in which an expense has been incurred but has not been recorded. This type of an adjustment is called an accrued expense.
It's important to note that when these adjusting entries are done, it's not because the accountant has done anything wrong, but rather the opposite. The accountant is merely reflecting the fact that an expense has been incurred.
Remember, these adjusting entries are made at the end of an accounting period. It applies the accrual basis of accounting to transactions that overlap between accounting periods. The accountant must make the adjusting entry or a business's financial statements will be inaccurately prepared.
Let's now look at some examples of adjusting entries. At this point, things have become a little confusing, so Stan has hired an accountant to help out. We'll say that Stan's accountant, Corduroy Cal, produces statements monthly.
I like your style, kid. Welcome aboard. You're my kind of employee.
Our first example of an adjusting entry is for supplies expense. Some of the business's assets may be used up over an accounting period. This decrease in an asset account must be recognized. Because the asset has been used, an expense has been incurred. Thus, the dollar amount used of the asset must be transferred to an expense account.
After the first month of his business, Stan has used $200 of his supplies, which he has already paid for. Stan now needs Corduroy Cal to account for the fact that part of his asset has been used. An adjusting entry must be made to recognize it in this accounting period.
In his general journal, Corduroy Cal debits the business's supplies expense account for $200 and credits supplies for $200. This increases the supplies expense account and decreases the supplies asset account, sometimes called supplies on hand. This represents a decrease in the supplies, or the drills and ladders. Next, on to depreciation.
Now, when car salesmen talk about depreciation, they're talking about the decrease in the market value of an asset. But when accountants talk about depreciation, they're talking about allocating the costs of the asset to an expense account in the periods benefited by the asset's use.
Huh? In other words, while the asset is being used to generate revenues, the accountant has to allocate an expense for that asset. This represents the amount of cost used in generating those revenues.
The cost is recorded in an account called depreciation expense. Depreciation expense represents the amount of the asset's cost that we want to expense in a given year. There are many ways to calculate depreciation, and some of them are complex, so we'll save it for another tape.
The effects of depreciation are shown on the balance sheet through a separate account called accumulated depreciation. This is also an asset account, but it is different in that it's a contra asset.
We will explain this in detail later, but for now, you need to know that contra assets are the only type of asset that gets credited when they increase, because their purpose is to decrease the book value of an asset.
Here's Sunny Day with an editorial. Sunny?
So, to reiterate, a contra asset is different than a normal asset in that it gets credited when it increases.